say, so little time. So I apologize. Backyard Bob, Rodney G, Rogue Bro. Did I say that right? Is Raj Bro or Rogue Bro? Florida Woody, good morning. Tim, Trains, Bart F, Peter Schrader, Captain Vicky, good morning to everybody. Listen, I'm going to tell you right now, this is the hardest market I've ever seen to trade. I've been doing this a long time. There's nothing hard. This is brutal. Most of the indicators just don't work. You're in a wonky environment. The spreads are widening. The algos are messing things up. We're detached from fundamentals. Traditional technical indicators that you lay out there work for about 5 minutes and then they just go blah. It's really hard. So if you're intraday trading, I pity you. If you are position trading, I think you have a better shot at this. So just want to throw that out there. I'm going to skip a beat. In the second half of the program today, I'm going to rotate. I'm going to do something which I have never done, but I'm going to do a recap of a program I did last week. I call it before and after. I did a program called Perverse Logic, an invasive critique of Wall Street's fuzzy math. I've said this time and again. I say this all the time. Most of you don't listen to me. It's fine. Fundamentals don't matter day to day. They're worthless. But in the long run, fundamentals are going to expose you, either make you rich or make you poor. The charts aren't going to make you rich, people. You have to be in the right trade at the right time, and the fundamentals will expose you. As John says, Warren Buffett says, when the tide goes out, all the phonies get exposed. You get to see what people are really made of, especially people like Cathie Wood. Okay, because again, the fundamentals were never there. She used charts. The fundamentals came into play. She gave back 80% of what she made. I'm not picking on her brain. I'm picking on her performance of risk management and a lot of how she did no fundamental analysis. It was just purely on momentum. This market's going to rip you apart. I'm going to talk about 4 or 5 of the short positions. I told you that if you only, I said this, I said, get out of it now, drop, get off the program with me, go to your trading screen, get out of these garbage stocks. I nailed all of them. I told you the market is in transition right now. We're at the top of a market. We're going to have a very long-term correction. I can't tell you the day or the hour. It might be November. It might be December. But it's starting to work its way in faster and faster every single day. And all we're doing is like a hamster in a cage running and going nowhere. And eventually what happens is you can't go any higher. The downside trapdoor opens and it's all over but the crying. Today's program is courtesy of the expression vicious cycle. Every one of you has heard this idiom, vicious cycle. Let me define it for you. Okay. What is a vicious cycle and why do I bring this up? A vicious cycle, pardon me, or a vicious circle refers to a complex chain of events where one negative situation leads to another situation, creating a feedback loop that exacerbates the original problem. So it's just like a trigger effect where when one thing occurs in an event, everything gets triggered and it just gets worse and worse and worse. And there's no way to back this out because you're inside of a feedback loop. This is what's going to happen to this market. It's already a done deal. You haven't seen it. We're going to unwind. You might as well get out today while you can because it's coming faster and faster every day. In economics, a vicious cycle can occur during a recession or during a boom where high unemployment leads to decreased consumer spending, which in turn causes businesses to cut jobs, further increasing unemployment. I'm just throwing this out there. That in the context of the subprime mortgage crisis, you had falling housing prices, which led to increased foreclosures, which further depressed housing values, creating an economic decline that fed on itself and blew out the economy. Okay, so yesterday, Ray Dalio comes out. Who's Ray Dalio? Okay, he annoys me a lot because he tries to act like he's some type of like religio Jim Jones type of prophet when he's not. But I'll give the guy credit. He's incredibly intuitive. He's incredibly, what I call he's a very deep thinker. He's a quant geek extraordinaire. He built up Bridgewater Associates a number of years ago in Greenwich, Connecticut, to the largest hedge fund in the world. So you can't come back at the guy. You can't poke fun at him. You can't call him a moron. You can't go down that path. It just doesn't work. You have to give respect where respect is earned. So I give a lot of respect to Ray Dalio. I do, for billionaires who made it. But Ray Dalio said in the recent interview, and I love this interview, he calls the interview, and I love the description of it. He calls the interview, okay, the stimulation to a bubble. You've never heard this, so it's called stimulating into a bubble. So give me 5 minutes of your time so you can understand what you're up against. Because we're down 62 today, but when we're down 1,000, all of you are going to crap the bed, all of you longs, because it's going to happen eventually. Dalio issued a stark warning that the Federal Reserve's decision, and Garrett's hit on this before, the Federal Reserve's decision to halt quantitative tightening, they've halted it now, marks the beginning of a dangerous cycle, which he calls stimulating into a bubble rather than responding to economic weakness. What Dalio's doing is he's propping up the market and throwing the economy under the bus. That's what he's doing. The billionaire investor and Bridgewater Associates founder argues that the Fed's shift from balance sheet reduction, which is what they were doing, now to expansion, represents a classic late cycle stage debt dynamic that tends to lead to market meltdowns. Dare I say, he said, a market crash. You have to understand where he's coming from, okay? The Fed said that they would end quantitative tightening effective December 1st, 2025. They said that. But at this point, they were transitioning to balance sheet maintenance at 6.5 trillion while redirecting agency security income into treasury bills rather than mortgage-backed securities. Dalio views this maneuver as what's called as a technical maneuver, as officials describe it, particularly a shift occurs alongside large fiscal deficits and strong private creation. So what Dalio's telling you is this. The Fed is supposed to reduce their debt balance sheet. They're not. They're actually increasing their debt balance sheet because they're plugging more money in the economy over and over and over in these repos to save the market is what they're doing. So it looks like a cycle where the cycle of debt goes up, then the Fed reduces it, then they take on more debt, then the Fed reduces it. So it's a debt cycle that feeds on itself, and it's ever nonstop growing. This is what's happening. We started at like 2 trillion, 4 trillion, 8 trillion. Now we're up to 40 trillion. It's feeding on itself. It's a cycle that keeps resetting itself higher instead of resetting itself lower. Along the lines of what Dalio said, so you can understand how the debt cycle works. So I'll walk you through this because this is a really good stylized depiction. The market is short of cash. It's just short of cash because it's all levered up based upon margin debt. So everybody's cash poor. They're borrowing like crazy. Once the market comes down, the Fed has to inject cash into the market to continually prop it up and elevate it. What happens is the consumers are now short of cash because they're all tapped out. They completely maxed out their credit cards. Their balances have grown untenable. So now they have higher interest payments. So even if they come in month after month to reduce the balance of the interest payment, it doesn't matter because the interest is eating them alive. Then they have the same amount of income or even lower income. If they get laid off, they don't have the same amount of income. They have less income. See where I'm going? It's a vicious cycle. Look at the debt cycle. Then they have to do what? They have to pay their bills. Once they pay their bills, they find themselves short of cash again. So what do? They reach for the credit card. Then they start levering up the credit card again. Their balances grow. They have higher debt payments, but their income doesn't keep up with the debt balance they're taking. This is the consumer. Picture in your head what's going on at the broker dealers. Picture in your head what's going on at the hedge funds. The exact same thing's happening. It's everybody playing a poker game. They're all in. They're levering up more and more on the margin, okay, on this AI narrative trade, wishful thinking. And you're building this debt cycle. And it does not mitigate. It pyramids higher and higher and higher. Now, here is the ultimate, like what you need to see, what comes through in the end. This is something I'm surprised Garrett didn't pick up on this. Okay. This is what we call the federal interest payments. So since the Fed started loading up on debt around 2008, this is their quarterly interest payments, seasonally adjusted. See what's happening to their interest payments? But since the Fed keeps injecting money from the repo market into the stock market, their payments on a quarterly basis are now effectively going vertical. It's what we call in the business harmonic. It's logarithmic. The borrowing is exponential, which makes the payments exponential because it's interest on interest. It's compounded over and over again. What the Fed's doing is they're taking on more debt and they're not paying it off. They're periodically reducing it and then injecting it back in. So over and over and again, the cycle feeds on itself. Dalio's point is simply this. You can do this. You can do that into a recession. You can't do that into a market bubble. Dalio says the market bubble's there. Everybody knows it's there. We all know it's a bubble. But when you do it into a bubble, you're not stimulating it into a recession to get us out of it. You're stimulating into a bubble, which causes the bubble to burst. So Dalio's saying that at some point, okay, the GDP continues to maintain 2% or lower. The inflation rate's 3% to 4%. Bonds are going to go higher because Dalio says they may go to 5 or 6% handle, which means that we're going to have 5 or 6% inflation, which means we're setting us up for stagflation. So what's happening now in like stylized terms is we're burning the candle at both ends is what's happening now. We're in a vicious economic cycle that's going to end in ruin. I wouldn't bet against Dalio. The only thing Dalio said is, okay, you can ease into a bubble. Okay, you can ease into a bubble rather than into a burst. But he warns that the classic big debt, late night cycle debt economics, so this is a late cycle dynamic, okay, tends to end in a reallocation or a what's called a reset. And typical resets, according to his research, are anywhere from 10 to 30% on the midstream side. That's the average. And on the horrific side, 30 to 40%. So you're going to get a correction of 10%. That's like a done deal. We might go to 20 to bear, but if we go beyond that because of the cycle of debt, don't be surprised to see us drop down probably 25% when this ends over the long term. That is Dalio's point of view. I would not make fun of it. I would not knock the guy. I think you should all start to wake up right now. Like we're at the beginning of the end of something horrible here. And the only thing holding up the market is the Fed and AI narrative. And that's going to eventually play itself out in the news cycle. Okay. Three things that came to my desk, courtesy of some of the TheoTrade insiders. Number one is cash strapped. The credit card delinquency rate, the recent print, October 31st, that's less than a week ago, shows a delinquency rate of 12.41%. To put that in perspective, that's the highest credit card delinquency rate among consumers in the United States since 2011. Clearly, the Fed's crapping the bed. They can see what's happening. You're going to get more and more defaults, more and more off the credit card. They're not going to pay this off. They're going to let it default, and they're going to try to apply for more debt. And of course, the banks will probably give it to them. So this is a setup for the consumer who's going to go into a bunker 2020 lifestyle like COVID, and they're going to be forced to save again. And that's going to put pressure on the economy. People will buy, they'll spend on what they need, but not what they want. Be aware of this. The second is, and I call it opportunity cost. Fact, I'm just the messenger, so don't come after me. Don't beat up on me. Don't come out there and drill me with like, a baseball bat. I'm just the messenger. But opportunity cost is the trade-off between what you do with your money and what you could have done with your money. So if you say I went out, I invested in Bitcoin $100,000 and you lose $20,000 on Bitcoin, it's not that you lost $20,000 on Bitcoin. That's shortchanging it. When you actually look at it, you're losing more. And people are like, why? Because you could have taken that 100,000, invested in the same duration in the S&P and earned 10%. So you're not just down 20,000. You have to multiply the 100,000 times the 10%. So the opportunity cost says you not only lost 20,000, but the 10,000 you would have made in the market. So you actually lost 30,000. You didn't lose 20. The opportunity cost says you lost 30,000. What you're beginning to understand here is we're in the longest shutdown in the U.S. history of the government shutdown in U.S. history. Every week that goes by that the government shut down is a loss in the U.S. economy of $15 billion. $15 billion is siphoned out of the U.S. economy, out of the GDP. Every single week we're down. So we're now in basically the fifth week of the shutdown. So now we're down about $75 billion. So if you want to put a finger or a figure on how much money that's declining every single week for the government shutdown, and I don't know what this is going to end, but let's just say it ends tomorrow morning. We've still lost 75 billion in the US economy. And that simply means the GDP is going to be lower. It means that earnings are going to be lower for companies. I'm telling every one of you, you need to reset your expectations. A lot of you are out of control. You've got to take it down. Be more, I'm not saying be bearish, be much more conservative, because the government shutdown ultimately is going to weigh on the economy. Maybe not now, but down the road when data statistics are finally released, it will show up then. The last thing I want to throw out here is what I call the term economic downshift. And people like say, what does he mean by economic downshift? Well, there's a pun on the word downshift, because you know when you drive a car and you have a 5-speed, manual car, stick shift, you downshift. Yeah, it was reported last night, and I pulled it off of Bloomberg. Car sales continue to move in the slow lane. What's a miracle to me is that not more than 2 or 3 weeks ago, General Motors comes out and says, we're kicking ass. We're going to raise numbers. And the market bid on that crap sandwich, which was to me just a lie. And they ran the stock up. People, you're buying into a mythical narrative by the car companies. How can their sales get better? Car sales are actually slowing down in many areas and declining in other areas. You have to moderate your thinking here. Like for the super wealthy, Ferrari, you could put an asterisk next to Ferrari because Ferrari's a unique circumstance. It's for the super wealthy who are unimpeded or unimpacted by market events. They don't care. But for the average Joe six-pack in America, okay, this is important. Interest rates are going higher, car defaults up, and now car sales. People, this is a recipe. Like if you can't see this now, when the market's down 1,000, I'm not going to shed a tear for any of you who are bullish. I'm sorry, Gianni. I ain't going to shed a tear for you either. You got to see what's happening. Wall Street's here, Main Street's here. I'm reacting to both. I'm timing Wall Street, but I know Main Street's hurting and it ain't getting better and it's going to get worse before it's get better. So I'm picking, hand picking where to go short here and there. And the short trades for me are working really well. The long trades, I'm few and far between. I'm skittish now because, again, we could easily take $1,000 point airdrop. 1,000's nothing, because we're up from 4,800. That would be like a mere flesh wound. It'd be nothing, 1,000 points. We could do it today. These are all telling us that the economy is not getting better and the market's not even pricing it at all because it's completely hung up on the AI trade. Most of the consumer stocks have been destroyed. They've already corrected. Walmart, Costco, BJ's, they're taking them down. They're already knocking them down. They've taken down the food companies, Starbucks, they're bringing them down. That's been reflected. What hasn't been reflected are technology stocks, cyclical stocks. Those are yet, even like toy stocks, which are consumer discretionary, are going up when the economy itself is starting to be on lean. So be aware of all this data. This data doesn't mean you run out the door and go, I'm going to get 100% short. I never said that. I have long positions. I'm just telling you, cut back your exposure to the long side. It's pyramiding with all the bad news, and the market hasn't priced this in yet, okay? Individual stories. Again, I'm just trying to be a little bit of a comedian here, but the end is not near, okay? Qualcomm. What happened to Qualcomm? Okay, so Qualcomm reported yesterday. Now, the earnings were superb, but the end is near. Now, I am not the one who made up this quote. I'm not making up this quote. I'm not, okay? I'm just paraphrasing the CEO of Qualcomm. Gianni, you need to listen up, Gianni. You didn't hear this? Qualcomm said that the semiconductors, all of it, is coming to the end of a cycle. It's the end of a upgrade cycle. This is from the CEO of Qualcomm. Okay, I'm done. I'm out. I ain't touching any. My semis are gone. I have no semis. I'm not going to sit there and ride this to hell. When a CEO of one of the 5 largest chip companies tells me the cycle is coming to an end, the upgrade cycle, the AI cycle, it's all played out, you need to get out now because these stocks fall a lot faster than they're walked up. The stock's not down $8 because of earnings. It's not a buy on the rumor, sell on fact. That's not what this is. They blew out their estimates and the stock's still getting savagely beaten today. It's what the CEO said. The CEO is telling you in no uncertain terms, you need to lighten up. It's somewhere buried in here, down here. Now everybody's like readjusting their price targets on Qualcomm. Here's one at 165. Okay, here's somebody, they're all moving and moving around. I don't care. I don't go on analysts say. Analysts are goofballs. Analysts are liars. Analysts make up fake models to justify their positions. They buy the stock, they load up, and then they go out and they say, we have a position and here is our estimate. But of course you do that. You walk it into existence because you own it. You're agendized. You're not objective. The idea here is this is the CEO telling you, he's objectively telling you, the semiconductor cycle has peaked. The reason why he has to do that is because if he doesn't do that, that CEO, he can get sued for not disseminating material information that impacts his stock. He's doing this to protect all of us, to say, listen, I'm not telling you to sell the stock. I'm telling you, if you own my stock, go out and buy the puts now so you can protect yourself on the downside, because we're looking for some type of air pocket in the semiconductor business over the next year. Be aware, people. You're like, I'm going to go buy Alvago. I wouldn't be doing that. Not when Qualcomm is telling you. Okay, so the things are starting to get like they're starting to get lightning. They're coming to an end, and that's that cycle. Be aware of that. That's why I called it end is near. I could have called it end of the line, but that wouldn't have done it either. Another one, dash for trash. Oh my God, are we going to hit on this, people? We are going to live, breathe, and die and play this. Okay, I don't want to spoil this because I'm going to hit on this in the second half of the day. How many times did I tell you, TheoTrade members? How many times have I told you, okay, this stock is a scam? I told you it's a phenomenal company, but it's completely disconnected from valuations. All these analysts, they make up like fake mythical numbers. How did DoorDash, how did that stock go to 285? How did it do it? It went to 285, and the best quarter they ever had was 65 cents. And they were losing money until last year. So you were basically trading the stock purely on one thing, narrative and the chart. Because if you looked into the Analyze tab, I told you, look at all the stuff that's going on with this company. They have profit margins of 6%. They were pricing this company like a tech company that had margins of 35%. Their return on equity was 9%. Their growth, their long-term growth is 9%. And they were pricing the stock at 40% growth. I told you that I said over and over, you can fool the market some of the time, but you're not going to fool it all the time. Once the money managers start to see it sort of ebb, and they're going to sell this like it's cancer. This is a toxic stock. I wouldn't touch that stock with your money. I told you to get out of that stock. I warned you. The company came out with earnings, 55 cents. Not only did they miss the estimate, that wasn't the worst part. The worst part was the CEO says that they need to go out and raise more cash to continue to grow. That's not good. They are thin on cash, people. They have a cash flow issue, is what the CEO is saying. And they're going to have to do a secondary. That's why they're killing. The earnings miss is bad. I will give you that. But the stock's not just down 35. It was already coming down because a lot of people knew they were going to miss. It was the fact that the company says that they have cash flow liquidity issues. This is what Blake's been talking about for weeks. A lot of these companies are living on debt, and the market just goes, well, if the chart's sexy, pile me in there. I keep telling you, I lived through crashes. I've lived through 87, 96, 2001. They all have the same thing in common. Charts go parabolic. People get ahead of themselves. The narrative's ultra bullish. And then you get Jim Paulson saying it's different this time. It's never different. It's the same every time. It's when the stock is up, get the hell out of it. That's the nature of the business. Garrett tells you all the time, what's the point of trading? To sell. You need to sell to lock in a gain. You need to short, okay, to trigger something. Don't sit there and live on this thing like Microsoft's going up forever. It's not. It's going to correct at some point 50%. Just don't be the last one out of the pool. That's the whole point. If you sell it early, who the hell cares? I'd rather sell it early than sell it late and give it back. I will profile this later on. I call it dash for trash. People, DoorDash charges an enormous amount of money to deliver to your door, and they don't even deliver it. They leave it in the front door of our building. They just leave it out there for other people to take and steal, or some pigeons can come down and eat this stuff. And they charge an unbelievable. They might drive 3 blocks from the restaurant and charge $15 for that 3-block drive, on top of the fact that you're paying for a meal. Unbelievable. And you could have Uber, you could have Lyft. They could crush their business and put them out of business. That, I just don't see why. You get out of this stock now before it gets worse. Take a look at the technicals on this thing. You don't think it can get worse than that? Oh man, I wouldn't be surprised to see it go down to 100. I think it's like, taking a massive hit today, and the dippers are going to come in and think it's opportunistic. But if I'm looking at this on a monthly, I'm thinking to myself, man, this stock's got a long way to go to retrace. It's broken an upward channel that's been in place for about 3 years. This stock is on life support. Get out of it even now. The next other two on this, that love and feeling. Again, I'm going to give props where props is concerned. People, I'm not a perma bear. I'm not. I'm bullish on a lot of stocks. I bought all the oil stocks none of you bought. I bought Schlumberger at 32. I bought Devon at 32. It's ripping up there. People, I love buying. Don't get me wrong. I own a lot of long stocks. I just don't chase stocks that are kind of like too pricey and too risky for my portfolio, because I don't want to take the ride down like a dash. But I will give props where props is. Okay, I'll acknowledge good trades. Gianni made a phenomenal call on AppLovin. Didn't know what they did for a while, but this stock still has life left in it. If you look at the stock itself, okay, and I call it that lovin' feeling because it's AppLovin. If I have to explain that kind of pun to you, I can't help you. So I want you to look at what the stock did. Okay, few things to understand here. Number one is, if I own this stock, I would have bought a put and hedged. I would have sacrificed probably $500, but I still would have made $1,700. I would have hedged this no matter what. But the stock came out with earnings. Look at the earnings. Look at the earnings. They beat by 9 cents. Now, I know it's not a lot, but believe you me, the stock had already come down $150 to reflect what could have been a thin beat. So the thin beat was already factored in. They just unexpectedly delivered better than the market actually wanted. But more importantly was their sales and their guidance, and that's what's driving it higher. Now, me personally, I won't buy this. But if you came out to me and sent me an email saying, would you buy this? Okay, and it's not me. Yes, I would. I think this stock's got room. I'm with Gianni. I think this stock's got room to move higher. The PE ratio is coming down dramatically. It was at 1.600, then 300, then 100. The PE's compressing, so it's growing into its multiple. That's a big difference between companies that can't grow into multiple, those that can grow into their multiple. This is not a bubble multiple. Not for a stock this young, a disruptor who monopolizes what they do. See what they do. It's a great company. They build software-based platform for advertisers and monetization of content. So they're doing a lot of business, obviously, with Meta. They're doing business with LinkedIn, obviously. So if you want to short this, go for it. I wouldn't short this just yet. I would not. I was really impressed. And then I did what's called a comparative analysis on this. And I was like, well, what did this company report previously? They went from $1.25 to $2.45. So let me explain this to you as a finance professor. I'm teaching a class tonight at Loyola. I'm having a heart attack. I'm trying to get students to drop the class. It's the largest class I've ever taught at the grad level. Normally I teach only 10 students, like 10 is the perfect. They threw 28 at me. So I'm going to walk in there today. I'm going to scare the shit out of them, forgive my French, and try to get 10 of them out of there because it's a huge workload. It's applied portfolio management. The idea here is, if you look comparatively at what they reported to now, it makes sense. They doubled their earnings. So when you tell me that's a bubble, I can't listen to you. It's not a bubble. They doubled their earnings. If they doubled their earnings and it was at 1,000 PE, then you have an argument. You don't have an argument here. They were already trading at 100 times earnings. So the fact that they had a 100% increase only validates the multiple. And now that they reported, the multiple falls further. So now the next quarter, if the stock goes up and they report 75%, the multiple will fall further. They're growing into their multiple and they're delivering by comparative reports that make total sense, that are in line, that validate the multiple. That's why that stock keeps going. This is a bad short. Gianni nailed it. Now he's not an academic guy. He's not a finance guy like I am. But he likes the chart. The chart looks great, but I'm telling you, they have a niche that they're like controlling and they're making money hand over fist and the guidance was good. So, do I think this is going to go to 900? I do not. Do I think it's going to go higher? Yes, I think it will retest that high and then try to break through. But I think that this stock still has legs underneath it. The only way I think this stock kind of like just falls apart is if the market itself drops 500 and this just gets pulled down with it by a correlation factor. If the market drops and this is correlated with the NASDAQ, it'll drop. But if the NASDAQ falls and this doesn't fall, this is a bad short. This is one stock I think Gianni's onto something, and I'm actually constructive on it. The last one is what I call missed a spot. You ever heard the pun? Hey, you missed a spot. Okay. This is one of those stocks that's hit or miss. HubSpot is a stock that if you don't know what you're doing, I call these stocks the widowmaker. This is a widowmaker. This is the stock that's going to bankrupt a lot of you. A lot of you are going to get crushed in a lot of these tech stocks. And you're going to come to Genesis Cog going, I had $1 million, I got a 500, what do I do? It's going to happen to some of you. You have to understand, it's not how smart you are, it's how you manage the risk. You have to know fundamentals. You have to understand algorithms. You have to understand charting. It goes all together. You might have thought like, hey, the stock came from 881 to 482. It's a bargain. It's not. That's what we call in the business bottom fishing. Bottom fishing is the death of your account. You think it can't go lower and it just walks itself into oblivion until you quit the business and throw up. People, you're thinking 375, it can't go any lower. People go to zero. I don't think it will. The problem with the stock is, and they had good, it's not like they had bad earnings, they had great earnings. The problem with the stock is that they have declining comp sales. So as time moves on, they're going to have to grow into their earnings. So now at 375 and they've earned about $10, now they're sitting in a PE multiple of 38. So what you're telling me is that if you're buying this stock, you think this stock's going to grow at 38%. If you do, then go buy the stock. Go for it. But if you think this stock could contract their multiple at 20, then why the hell would you buy this? You're buying a stock because you think its earnings are going to improve. But if the earnings improve, but the multiples don't expand, it won't make a difference. This stock is a victim of its own success. This is what's going to happen to Palantir. This is what's going to happen to NVIDIA. All stocks are going to do this eventually. You don't think so. I know so. It's just when will it happen? Nobody knows. But when a stock goes vertical and gets massively overbought, I just want out. I don't even care what the value is. I want out because by the time the valuation discussion comes into play, the stock will be down 500. Oh, look, it's down 500. I love shorting, but I only short expensive. I never short cheap. And this, to me, is not that cheap at all. I wouldn't short this because it's come down too far, but it ain't cheap enough. Be careful. In the long run, I say this all the time, and I repeat myself. Fundamentals don't matter on the way up. They never do. On the way down, they expose people and destroy accounts. That's what they do. You've got to know fundamentals. Trade what you know what you trade. People trading this thought that this was going to last forever. It's not. Neither is Oklo, neither is NVIDIA, neither is Palantir. It's not going to last forever. It could last for a while, but eventually everything normalizes. They're a victim of normalization. Now, without further ado, I don't really have a slide deck, but I want to go through the stocks that I covered last week. I did a piece called Perverse Logic. It was all last week. I started on Monday, I ended on Friday, and then I started this Monday with the Ask the Analyst segment. Then I pivoted and went towards the, what did I pivot towards? I went from Ask the Analyst segment towards it was the Elder Impulse system. So here's what I want to throw out at you. I want to talk about a number of stocks that I've pinpointed that were rather expensive. And I said unequivocally that, I'm challenging these analysts. Okay. They may be richer than me. They may work for a prestigious firm. I don't care. I'm older than you. I've been around as long as you have. I've been around almost 40 years. I've written hundreds of research reports. I've been mentored by a lot of brilliant, analysts and portfolio managers myself. I was fortunate enough. And I read a lot of books. And what I can tell you is there are certain stocks where The logic is just it's untenable. It's perverse. It makes absolutely no sense why any of you would ever buy this stock at its current level. And I said one of them was Dash. So I got an email. Somebody asked me, would you short the stock? And I said, I would love to, except for one thing. I can't trade ahead of earnings because earnings are one of those wild card X factors where nobody knows how to handle it. I don't know how to handle it. They beat, they crash it. They beat, they miss, they rally it. It's utter what I call utter nonsense. I call it utter nonsense. So here's the company reporting, okay, missing, which I didn't think they would, but who cares? It was the warning. But I kept looking at this stock over and over, and I kept telling you, take the chart, put it aside. The chart is massively overbought. It's on an algorithmic run. You can perfectly see it. But I kept saying, like, I can't short it. And I fired back, and people kept asking me, you're so bearish on Dash, why can't you short it? I said, I never short anything that doesn't break an algo channel because the market is the pricing mechanism's broken. The Fed broke the pricing mechanism. The pricing mechanism doesn't work on a day-to-day basis. It used to, it doesn't work anymore. It works on a year-to-year basis or a 10-year basis. Fundamentals only matter at 4 times a year. And for me, that's tough. So I'm like, I can't short on the way up. I never shorted it because I'm like, it just keeps walking up. I'm not going to short it unless it falls into a broken algorithmic channel where the algos will defend me. So I adhere to the Genesis Cog rules. But the fundamentals are the reason why I short it. It's not the when I short it. So I kept like harping on this, and Blake was the only one who stood by me. And I said, listen, Blake, I'm going to do a recap once the earnings come in and see how these played out. I warned you time and time again on this stock. Like book value per share doesn't matter here. It just doesn't matter per share. I said, what matters for me is the margins, and what matters for me is the profitability, and what matters for me is the liquidity of the company. That's what matters to me. So the liquidity of the company was pretty decent at 2 times, but apparently it's not because now the company says we need to go out and we need to raise more capital in order to keep growing. I find that interesting. Okay. But what I kept looking at was I kept looking at that return on equity. I'm like, why is the stock trading at a PE multiple in excess of 35, 40, 60, 70 when the return on equity is only about 9%? That means the company's using its equity to generate organic growth and it's coming in at 9%, but they're pricing the company as if organic growth is 50%. Why are they doing this? And then I kept thinking to myself, well, they're just giving props to the sales. So they're looking at the sales here and it peaked out during the COVID years. Then of course it took time to rebuild that because people were like, hey, you know what? It just takes time to like get people back to work, get people working full time. When they come home, they're tired. They want to order from DoorDash. So it starts to come back. But from year to year to year, the sales aren't jumping like 10%. They're jumping about 3 to 4% on a 9% profitability measure. And I'm like, this makes no sense to me. And you're like, it's up 696%. Oh yeah, well, that means previously their earnings were 4%. Okay, which means they were making even less money. But at some point in here, I'm like, what matters to me is that net profit margin and the return on equity. The margins are razor thin and they're charging a ton of money to drive around Chicago. I'm like, how are they getting away with this? You have to order through DoorDash and you got to tip them and you got to pay them $15 to drive a half a mile. Like I kept looking at this thinking, why not just have Uber and Lyft do a push forward and put them out of business? So I kept looking at Dash going, the only thing people care about is the narrative. But at what point is Dash going to be is what I call fully saturated? It's like Dash has completely reached a point where it just can't grow anymore, where it just at some point it reaches that peak level. Apparently it was $285. That was it. I didn't know. But now that they report, I begin to realize, like, look, listen, the debt's not going to bury them. It's not going to bury them. But unless they can get those margins up, they can't, quote unquote, grow anymore. The only way they can grow is to get the margins up and the return on equity up. And at this point, it looks like it's peaked. So that's the reason why I picked on this. They made 29 cents last year. This year, they're up to about $1, maybe $1.20, but that still puts them at a PE ratio over 100. So unless this company is going to grow at 100% year on year, you have no business buying this. If you go through the stock and see how long they've been public, They've been public since 2021. So they've gone from about what, 50 to 285. That's a 500% increase. And all of a sudden they're starting to show profitability now, but they're doing what's called normalization. Normalization means, hey, if you draw a line of growth, and this is a line that's about what? At about a 15% growth clip, this is where the stock's long-term trend is. They're worth about $167 to $165 on their long-term trend growth line. Now, I've missed the trade here, but I kept saying over and over, I harped on this, and Blake validated me. This was just simply fuzzy math, and they got exposed for it. This is not a pat on the back for me because I didn't trade it. I missed this trade altogether because I don't trade around earnings, and they didn't break the algo channel in time. But I can tell you this. This is me giving you a heads up. I'm telling you, okay, I've been around. I've lost a lot of money. I have a lot of anxiety at times. I've had a lot of headaches. I can tell. I'm in your shoes. I'm in your head. I know what you're thinking. Stop getting hooked up on the news media and the charts. They don't last forever. They never do. So when you're looking at something like this, remember, it went to 229 back to 41. Things that go up eventually come down. This is not a referendum on DoorDash, people. This is me telling you, dig into the numbers of the things you own, and if they don't add up, hedge them or get rid of them because you're going to be exposed one way or another. Money managers who own this, who are selling this today, are going to have to like meet their maker because when clients say, well, why the hell didn't we sell this at 285? That manager is going to lose that client. There's no excuse for giving up $85 in 3 days. That is unforgivable. Just get out while the going's good ahead of earnings, or at the very least, just hedge it. Another one of my calls, okay, while I was up there, and I said this, I cannot and I will not short into a hole. I just don't. Listen, I've been conditioned by Kaufman. I've been conditioned by a lot of things in this world. And the one thing I know is more money is lost, not by shorting into an overbought condition, by an oversold condition. You double down your risk. So I can't short this stock if my life can on it. But I said to you, okay, this stock is an absolute fraud. I told you DraftKings was a fraud. I told you it was going to break 30. It wouldn't surprise me. It wouldn't surprise me at 25. I never, ever trade ahead of earnings. I want nothing to do with it. If I see earnings in the Genesis COG, we do one of three things. We either close out the entire position and watch it. We either buy the call if we're short, or we buy the put if we're long. That's how we do it. I just hedge off the position in front of it if I want to stay long or short ahead of the earnings. But I never sit out there and put the Genesis COG members on a line going, you're out there on your own with HubSpot. I'm not going to tell you what to do. Are you kidding me? They'd fire me. And it'd be rightfully so that they dunk me. They should rip me. They should rip me an A. You know that. The point being here is the stock was oversold. And last week when it was 32, I said, I won't short into a hole, but I can tell you this. DraftKings is a fraud. I told you. They're competing against so many other players. Caesars, Wynn, Vegas Sands, Robinhood. Robinhood's stealing a ton of their business because Robinhood's not betting on sports. They're betting on the outcome of political events like Mamdani's win. Get it? And I was like, well, hell, you don't need DraftKings anymore. Then you look down and you go through their numbers, and I'm like, this is just all fuzzy math. And I went through the math on this. I kept saying, what matters is the margins. Their margins are negative. Okay? What matters is their cash flow. And their cash flow completely stinks. Their debt is way, they have 65% debt. Their current ratio is enough to keep them going. But the fact of the matter is, all of their profitability measures are negative. All of their earnings are negative. You're like, well, they're turning a corner. It seems like they're turning a corner, but they're turning a corner only if the market continues up. If the market corrects 25%, that stock's going to crash. Why? Because people who made money are willing to go to DraftKings and bet on sports. They're like, hey, I made 100,000 on Bitcoin. What the hell? I could lose 20,000 betting on, DraftKings on the stock. They will do that, but they're not going to do it if the market pulls in. This is a prisoner to the market, and it's no longer a disruptor. FanDuel, you have so many different options and outlets to gamble. You don't need them anymore. Not only that, they've never ever turned a profit. It's called betting on the cum. Betting on the cum is the Latin word for I'm betting on a future outcome that they will become profitable. Okay, that works for Amazon. That works for Google. Is that going to work for this? I don't know. I don't know because there's just too much out there in terms of market share to beat it. And you're not really a disruptor. It's not like people haven't been around gambling. It's just that they're an online gambling firm that spends a lot of money to market and get on ESPN to give you their money. I said if they report and don't deliver, they could dunk this. Take a look. I told you. Now they lost more money again. Again, I have a rule. It's my rule and nobody else's. I just don't buy companies that don't make money. I just won't do it. I don't care if it's a biotech. I don't care. The thing that matters most to me is, okay, you have to make money or I'm not interested. Because what eventually happens to companies that don't make money, they look like Peloton. They go from 150 to zero. That's what happens. You go from Neo from 54 to $4. Under Armour, you start losing money and you just go down to your book value. Okay. I've been through it. I bought companies where I'm like, it doesn't matter what they earn. And the stock dropped $50. Been there, done that. What was the mistake I made? I bet on the Coon. I was like, well, the sales are more important. No, they're not. Nothing's more important than earnings. Earnings, profitability drive a company. No profits. Eventually what happens to no profit companies is they get delisted. This is not going to be delisted. But I'm telling you, this is a situation where if you look at the valuation and they don't make money, walk away from that. Go curate your portfolio. Go through all your portfolios now. Find every stock that doesn't make money, either sell half of it or just say, I'm going to hedge it with an option. Don't sit there and tell me the market's not going to get it. When we go down 500 in a day, because I think we're going to drop 400 to 500 in one day, all your arguments about, well, this and that, nobody's going to care. The first stock they're going to sell they're going to sell the stocks that make no money. They're going to beat the living snot at every stock that makes no money. As Gianni says, they're going to rotate to strength. They're going to go, hey, they killed Meta. Who cares? Meta makes $20. They're going to go into the companies where if the company takes a hit and gets battered, they're not going to sell it. Why? Because the company's going to come back because it makes a lot of money and it cash flows. The companies that don't cash flow are going to be exposed and they're going to drop out to nothing. That's what happens in the end. Go look at all the biotechs that were 10, that are now penny stocks. What do they all have in common? They're worthless. The market exposes it. They are a fraud. And you know what else is a fraud? I told you over and over again, and I have the list here. I said, listen, on my other chart, and let me pull this up. I said, listen, Roblox is a stock that's a fraud. Roblox doesn't make any money. They've never made any money. They're an incredible company because they reach millions and millions and millions and gazillions of young kids. I get it. Between the ages of 10 to 40, they have a monopoly. I get it. But then again, so does anybody who wants to go out and say, hey, let's let Microsoft do this. Take-Two. Everybody can do it. Electronic Arts, they can create their own sites and put them out of business. What I'm telling you is, okay, I set up here last week, it was 133. And I said, I never trade ahead of earnings. But I'm telling you, even if they beat their estimate, there's a likelihood that they could still crash this stock. Okay, here you go. Bam. They beat their earnings. It didn't matter. It didn't matter. Yet again, the company lost money. If I were to put any of the Genesis Cock members in the stock, I'd have 0 members. All of them would leave me. This is not a stock that's quote unquote investable. When you're trading the stock, you're just throwing whim to the air. You're like, I'm going to buy it. Good luck. This stock could go to $10 and I wouldn't buy it. I'm not buying a stock that doesn't make money. It just doesn't add up. And you can sell me all on the sales. I don't care. I said Roblox is a complete, utter scam. It's just fuzzy math. The reason why I can't short it is because I can't fight an algorithm. An algorithm doesn't process math. An algorithm doesn't process anything. The only thing an algorithm cares about is one thing, okay? Slope, order flow, and that's it. And muscle memory of where it was previously to a support level. An algorithm doesn't process fundamentals. And I keep telling you, when the market eventually does correct 10 to 20%, don't you come back at me and tell me it's because of the charts. That's not why. It's going to reprice itself lower because it's just darn expensive, people. You can't commit suicide jumping on a basement hill. You're not going to reprice a stock that's at 4 times earnings to 3. You won't. But you will reprice a stock from 70 to 50 to 60 to 20. You'll bring that multiple down until that stock goes down 80%. That's what happens in a market correction. It's not the end of the world. It's the market telling you you got the risk wrong. You got the valuation wrong. We're just repricing and refixing the valuation to where it belongs. That's what it does. It's a misallocation of resources, and then reining in all of that valuation excess is what it does. This stock hasn't even scratched the surface of like correcting. It's oversold. So the buyers are like, well, it's oversold. I'll buy it. Sure, the dippers will come in. They'll bounce it to 120. And everybody who bought it at 150 is going to go, hey, somebody brought it back to 120. Chance for me to get out. And they'll get out. This to me is a losing proposition. Look at that weekly chart. Look at the air underneath there. If you don't think that can't go down to 50, you're smoking something. If you don't think these stocks can blow up, take a look at Abercrombie and Fitch. $196 to $68, people. There is a 2/3, 78% correction there, people. It happens to it doesn't matter. I don't care what it is. I don't care if it's retail. I don't care if it's oil. Every stock suffers this, people. That's the nature of the business. It's what math is all about. So I'm just bringing to light that I came here to do fuzzy math. I can't do math for you. That's not what I'm paid to do. But what I can do for you is tell you this. Go look at every single one of your stocks, and you better be darn sure that you are comfortable with that valuation. Because if you don't, your chart ain't going to help you. What's going to eventually happen is when momentum breaks, like it did here, all hell breaks loose. That's how it happens. These are the type of charts I never chase because I can't afford to look the Genesis Cog members in the eye and go, yeah, I bought it at 170. Yeah, it's at 69, but it'll come back. Give them that false cheer, that fake platitude. Once stocks come down, they don't come back for decades, for years. Wait till you see what's going to happen when they correct these things. They're going to get a lot of these things. They're not going to get them all, but they're going to get a lot of them. And they're going to bring them down in line with their valuations. If you don't know what fuzzy math is, then go back into the archives. Go into the archives. Go to the personal archive, my archive, fundamentals. Go watch all 5 days of me analyzing internally both overpriced and cheap stocks. Even the cheap stocks may not go up, but here's the thing. Their downside is mitigated because the valuations have overshot to the downside. They've overshot to the downside. Stocks that overshoot to the downside, they scratch my itch. Why? Because if I buy them, I can't lose that much money. These are the type of stocks that can bankrupt you. When up here, down here, where it's now 6 times earnings, ain't going to do anything to you. It may not go up, but it's not likely to go down either because it's trading a book. You're not going to lose money at this level. May not go up, but the likelihood of it going down, very small chance. That's what the beauty of the market is. If you can pinpoint the value, you can make millions because all you have to do is buy long before the multiple expands and the cash flow expands, and that's how you play it. What Wall Street does is it creates this air of FOMO, of greed, that value doesn't matter. It always matters. It matters on growth stocks. It matters on value stocks all the time. I never buy a stock or short a stock without analyzing the internals. Ever. Even when it comes up on the Genesis Cog scanner, I'm like, that's interesting. There's a sell trigger. I go right to the fundamentals. I go right, and if it doesn't fit, might scratch my itch. I'm like, I'll just avoid that. You got to be careful what this market does to you. The other last one I came out was, and I said this, I said, Pins is an absolute fraud. I told you, this stock to me is the beginning of that. This is no different than buying Meta. I would rather buy Meta that makes $20 or $40. I'd rather pay $600 for Meta than pay a penny for this. Meta is well capitalized. It's well managed. This is just a subset of Meta. They go out, they pick and choose, they curate and gather information on you. They see your spending habits, they see your page views, and they try to build pages to try to push and sell you items. So they're like, I know what that person's profile is for spending. I'm going to go out, put together a collage, and do a push notification in their email and get paid for clicks. That's what they do. That's how they're paid, by transaction and clicks. And I said this last week. I can't short the stock. I did short the stock at one point. I took a shot of the stock about a year ago, and I made about $6 or $7 way back over here. I shorted there after earnings on that breakdown. I covered over here at 30. So on the Genesis Cog, we made about $9. It was good. Haven't come back in since. Why? Because I don't trade around earnings. Earnings are too much of a wild card. It's too unpredictable. But I did say ahead of earnings here, right there, I said, listen, This is not a Genesis cog set up for a short. But I said, don't be surprised after Pins reports that the stock drops to 25. Was I right? I told you the earnings don't matter. They had 38 cents and beat. How'd that help the stock? They beat by 20 cents. It didn't help the stock. Why? Because the company itself said, quote unquote, that they did not raise guidance. They didn't. The market wants higher guidance. They didn't deliver, so they took out and shot the stock. This is a Genesis Cog broken stock. I wouldn't buy this with your money. I wouldn't buy this for a penny. Pinterest, okay? The PE ratio on the stock is down to 9. I don't care. The valuation could go to 4 times earnings. I might look at it, or it might go to book. So take it to book and I might find it. But if you really want to know what it's worth, you need to go out and crunch the numbers. It's easy to do. Add up the last 4 quarters. The last 4 quarters, the stock made about a buck $1.50. Divide $1.50 into $26. What do you get? You're getting a stock at around 18 times earnings. So it's an 18 multiple. Is that a bubble? It's not. It's not a bubble. When it was over here at 60, 70 times earnings, that was a layup short for me because it's a bubble. It's not a bubble anymore. But now the stock is trading in line with its long-term growth. What's its long-term growth? About 15, 10%. So all the market did was forget the chart. It's not going to help you. They just repriced the stock back to where it actually belongs for its long-term growth. This company is not a disruptor. This isn't Oklo. This isn't AppLovin. This isn't Palantir. Those companies are new edge quantum machine, like disruptors. This one is not. That's why this stock to me was a prime short. I wasn't willing to take it because the rules are we never trade around earnings. I'm not going to put my money where my mouth is when it breaks the rules of the Genesis Cog. I just obey the rules. But I said to all of you, go watch the tape. I said, don't be surprised to see that break down to 25 and sit there and die on the vine. When the economy goes in the crapper, and it's going in the crapper, and it's doing it in slow motion, I'm warning all of you, get out of this now. When it goes in the crapper, what's the first thing every company does to cut its budget? First thing, advertising. The first thing they do is cut advertising. Who's an advertiser? Pinterest. That stock is dead meat. They're a prisoner to the economy and the consumer. If the consumer's doing well and they're at full throttle, they're being hired, and there's no AI disruption and displacement, that stock could be at 35. But that's not what happened. Fundamentals matter, but they don't matter until they do matter, is what you learn. For me, I'm way ahead of the curve. I look at stuff and I go, that's an interesting chart, but that doesn't make me want to buy it. I have to buy it because it's compelling in terms of its growth, its book value, its cash flow, its profitability measures, its liquidity measures. If they don't align, I just don't want a piece of that because I don't want to buy it, watch it drop 30% in a day and look at the Genesis Cog members and go, well, there goes 30% of my members. My goal to Genesis Cog is not to be a home run, not a hero. I just want to make money in the most conservative way possible, keeping the risk at a minimum. If I can control the risk and hit singles, I'll just pyramid. Been doing it all year long. And the best part is I've been doing it more on the short side than the long side in a raging bull market. That's what happens when you manage risk correctly. If you get the risk right and you make a ton of money, you could give back a portion of that and go like, I made 30% and still give back 15% and still be ahead 15% just because you got the risk down right that keeps you ahead. That's always my goal. So I just came in today to do a small, an ever small recap. It's just a recap of the fuzzy math from last week. It's just like a before and after. I picked 4 stocks and I absolutely said, sell these, get out of these, or hedge these. And all 4 of them completely collapsed. On that note, I'm going to turn this over to whoever's coming up next. And I'm not sure who's coming up next, so I've got to check the, God, where's Kaufman? All right, so Brandon Chapman's coming up next. I got to let the gentleman in the room. I will be back tomorrow, same bat channel, earlier time, back in my 9:30 slot. I have to actually do a Genesis Cog at 11:30 today in about 30 minutes, and then I've got to get prep for an interesting day today, teaching up my first class tonight. But in the meantime, I'm going to let Brandon Chapman run with this. If you want to know what the market looks like from a perspective, all I can tell you is that the key breakout number, and you can all write this down. Guatemala, you can write this down, okay? The key number is 6550 to 6650. Everybody be write that number down. If we take out 6550, the trend is not broken, but the momentum is. And momentum breaks before trend. So once the momentum breaks, every rally will be sold. We are now officially in a downward sloping, descending algorithmic channel. So every one of you are buying this, you blew it. You need to start to hedge or sell into the rallies. Don't believe for a second that every dip is going to be bought. On that note, I'm going to turn over to Brandon Chapman and let him run with it. Brandon, are you there?
I am here.
Okay, well, Brandon, I just added some more shorts, and I'm just trying to scrape away and avoid like getting caught up on the long side here. I'm just kind of scaling out as best I can, but I did get short a couple of bank stocks.
Uh-huh.
I know that's something you and Don have been talking about. And I did get a re-enter short on a utility that I think is mispriced, but there's no way I'm stepping in here to buy any of these tech stocks. I think it's too risky.
It's tough. We're gonna leave the console today. I mean, for semiconductors, it doesn't look good. Brokers, hood doesn't look good. Yeah, I mean, yesterday we talked about it. It's just, I mean, that was the day to look to start to add some bearish positions if you hadn't already. And we're seeing that today is that we're just seeing that wash to the downside. This is where you're trying to close stuff, right? So we closed out a bearish position IWM. We got some other ones in there in Ghost Prints. We're trying to like close out in the next couple of days into the sell off here. But yeah, it's one of those things you got to take those opportunities like yesterday to add bearish position, take profits, hedge, that kind of thing.
Brandon, I'm going to probably call an audible tomorrow. I'm going to do a Genesis cog because I also took a short position in a broker that's down 5 today. So I want to show people like why I chose this broker to short, why, and not just the why, Brandon, but the when, because you have to, it's not just why, it's when and why,
Yeah.
and show you like more opportunity is made when you actually get the risk optimized in this business.
Mm-hmm.
And my expertise is I know how to manage risk at the optimal level.
Yeah.
And it doesn't work out every day, but when it works, Brandon, it really, really works. That's
Right. And that's the thing is, I mean, a couple of days, especially on the bearish side, I mean, you can really make huge gains, right? I'm like, and that's where it's just, you got to just be resilient and not just being caught up in bullish and bearish. You know, that's kind of a false dichotomy, right? I don't think as a trader, there really is a bullish and bearish per se, right? I mean, you might lean a direction, but are you going to be wholesale sell out? Probably not.
last thing to tell you, Brent, I never am 100% long. That's an
Right.
unthinkable. Never. Right now
Right.
I've got 9 short positions and 8 long positions. I'm always spread the risk across, so I never
Yeah.
get killed.
That's the appropriate tack to take. I agree.
All right, I'll see you tomorrow, Brandon.
All right,
Have a
we'll
good
see
day.
you, Professor.
All right, bye.
All right, let's get rolling here. So I'm going to share my desktop with you, and I gotta move my